Compound interest in property is just so important to your financial freedom. So let's have a quick look at it in a bit more depth. Because compound interest is so important to what we're trying to do, let's try and understand it a bit better by comparing it with simple interest. So simple interest we're going to show here in blue, and you can see it's represented down here as well. And compound interest is represented in orange, and as you can see, it's here shown also a bit in a better graphical way at the bottom here. So let's understand simple interest first. If you invest 100,000 in the bank and you're getting 10% per annum, then at the end of year one, you will get, as you will see here, 10,000, and at the end of year two, you'll get another 10,000. And in year three, another 10,000. So at the end of year three, you've got a total of 130,000. And it's what we usually understand by interest. But assets and property specifically works in compound interest, which is quite different, and you'll see over a period of time how it varies from simple interest. So compound interest, in year one, you still have the same 10,000. So at the end of year one, you have 110,000. And at the end of year two, you've got 10% on the 110, so that gives you 121. And at the end of year three, you get 10% on 121, which gives you 133. So if you look at this graph down below, you will see that in the early years, there's not that much difference between them. But over a period of time, and specifically over 20 years, there is a massive difference between the two. And it's this massive difference is one of the things we're going to use to really accelerate our achieving financial independence. And it's extremely important that we understand those two different things. In property investment, not only is each well-chosen individual property increasing compoundly, but so is your rental income. At the same time, only a small portion of your fixed expenses are increasing compoundly. The major portion of your monthly expenses, being your mortgage payments, are relatively fixed or can be completely fixed at purchase. You can therefore use this extra net income to borrow more money and invest in more properties so that you can really accelerate the number of properties you can own. If you can combine all of this with having more than one financial partner, then you can reach your financial independence goal just so much faster than you can by trying to save from hard-earned income. Let's have a quick look at risk. You're often in property offered high risk leading to high reward. For me, that's far too much risk. I want really good reward for as little risk as possible. Where then are the major risks? Number one, we borrow too much and we just can't pay it back. Number two, the market turns on us, and what we could once afford, we no longer can because our property income has dropped. Number three, a big hike in interest rates, and what was once affordable isn't any longer. Number four, your partner uses a downturn to just push you out of properties that you jointly own. And number five, your financial partner just can't fund a downturn. I've been through 5 of these big market corrections since I started in 1974. And each of these has been really different. So I will show you in my 2 courses what I believe is the best way to mitigate these risks. You just don't want to put a lot of thought and effort into becoming financially independent and then lose it all by just being unprepared. It is also hugely rewarding being prepared and forewarned and then riding through a rough patch and coming out the other side, intact, stronger, wiser, and even more prepared for the next one, which will surely come. The recent COVID-19 pandemic and its devastating effect on jobs everywhere should serve to wake us all up. Hopefully it will emphasize to us all how important it is to be financially independent and to just not rely on anyone else for our own financial security.